ACTEC's comments on Section 2053, Proposed Estate Tax Regulations. That's the subject of today's ACTEC Trust and Estate Talk.
Welcome to ACTEC Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers in the United States and around the globe. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. And now, our ACTEC Fellow host with today's topic.
This is Doug Stanley, ACTEC Fellow from St. Louis, Missouri. On September 22nd, 2022, the American College of Trust and Estate Counsel, ACTEC, submitted comments to the IRS regarding the proposed regulations section under IRS Code Section 2053. The proposed regulations affect estates of decedents seeking to deduct funeral expenses, administrative expenses, and/or certain claims against the decedent's estate. Today, ACTEC Fellow Kevin Matz of New York City will give us an overview of ACTEC's comments. Kevin is the chair of ACTEC's Business Planning Committee, who worked on the comment with the Washington Affairs Committee. Welcome, Kevin.
Thank you, Doug. Hello, everyone. So, on June 28, 2022, the U.S. Department of Treasury and the IRS published proposed regulations under Internal Revenue Code Section 2053 concerning estate tax deductions for estate administration expenses and claims. Now, these proposed regulations did a lot. They do 5 different things, or did 5 different things. They provide guidance on the use of present value principles, determining any amount deductible by an estate for funeral expenses, administration expenses, certain claims against the estate. In addition, the proposed regulations provide guidance on deductibility of interest expense accruing on tax and penalties owed by an estate, and also, notably, an interest expense accruing on certain loan obligations incurred by an estate. Further, the proposed regulations also amend and clarify the requirements substantiating the value of a claim against an estate that is deductible in certain cases. Finally, the proposed regulations provide guidance on the deductibility of amounts paid under decedent's personal guarantee. Now, if these proposed regulations are adopted in final form, they will affect estates of decedents dying on or after the date of publication of such final regulations. So let's drill down. Before we talk about ACTEC comments, let's drill down to the proposed regulations a little bit just to set the table a bit more. So number one, as mentioned, there's a present value concept subject to a 3-year grace period. Now, going in time warp to 2009, we had final regulations issued under Section 2053, which reserved to provide future guidance on the application of present value principles in determining the amount deductible under Section 2053. Fast forward to these proposed regulations 13 years later. And what these proposed regulations do is that they were calculating the present value of the amount of deductible claim or expense that is not paid or to be paid on or before the 3rd anniversary of the decedent's date of death. That 3-year window is referred to as a grace period. So when you get beyond 3 years, you have present value concepts. What's the interest rate? Proposed regulations say that the discount rate to be used is the applicable federal rate determined under Section 1274D for the month in which the decedent's date of death occurs, compounded annually. Now, the proposed regulations require a supporting statement to be filed with the Form 706 estate tax return, showing any calculations of present value. In addition, the proposed regulations provide that the expected date or dates of payment generally must be identified in a written appraisal document. Second concept of the proposed regulations, interest expense accruing on tax and penalties owed by an estate. So according to the preamble, the IRS determined that the amount of interest payable on unpaid estate tax in connection with an extension under Section 6161 or deferral under 6163 is necessarily incurred in administration of the estate. In addition, again, this is just setting the table, proposed regulations acknowledge, something I think was already known, that interest on estate tax installments payments that are authorized under Section 6166 are not deductible for estate tax purposes. It basically uses that to coin the term non-Section 6166 interest. Now, upon noting that, then the proposed regulations say, okay, let's look at everything else. in connection with non-Section 6166 interest. And they said that if it has accrued, the interest is accrued in unpaid tax and penalties in connection with an underpayment of tax or deficiency, and it's attributable to an executor's negligence, disregard of the rules and regulations, or fraud with intent to evade tax, the interest expense is not an expense actually and necessarily incurred in administration of the estate. Accordingly, interest on taxes is not deductible to the extent that the interest expense is attributable to the executor's negligence, disregard of applicable rules or regulations, or fraud with intent to pay tax. Now let's go to the meatier stuff now. Next up, interest expense accruing on certain loan obligations incurred by an estate. Now, the proposed regulations take aim and fire at the use of so-called Gregan loans. Right there is reference there to the famous Estate of Gregan versus Commissioner case, Tax Court Memorandum Opinion from 1988-477, and perceived attempts by estates to, quote unquote, and this is in the actual preamble to proposed regulations, concoct. That is a term of art in the preamble, illiquidity, not liquidity, but illiquidity, to be addressed through loan agreements with related parties that prohibit the prepayment of principal and interest prior to the loan's maturity date. Now, although the IRS's concern is understandable, this prescription that proposed regulations offer really goes way too far. Now, the preamble to proposed regulations acknowledge that some estates face genuine liquidity issues that make it necessary to find a means to satisfy their liabilities. And incurring a loan obligation on which the interest accrues may be the only or the best way to obtain the necessary liquid funds. However, the preamble to proposed regulations continues that if illiquidity has been created intentionally, and get this part, whether in the estate planning or by the estate with knowledge or reason to know of the estate tax liabilities. So we're not just talking about post-death, we're talking about pre-death too, ladies and gentlemen. Prior to the creation of the loan obligation to pay estate expenses and liabilities, the underlying loan may be bona fide, this is again per the preamble, but then most likely per the preamble will not be found to be actually and necessarily incurred in the administration of an estate. Now, proposed regulations provide that interest expense is deductible only if, among other things, the loan's terms are actually and necessarily incurred in the administration of the decedent's estate and is essential to the proper settlement of the decedent's estate. Further, the proposed regulations provide a non-exclusive list of factors to balance, to consider in determining whether interest expense payable pursuant to such a loan obligation of an estate satisfies the applicable requirements. Among them is whether the loan obligation is entered into by the executor with a lender who is not a substantial beneficiary of the decedent's estate or entity controlled by such a beneficiary, and at a time when there's no available alternative to obtain the necessary liquid funds to satisfy estate obligations. The preamble posits an example where either the need for the loan or any of the loan terms are, quote unquote, contrived, again, a word in the preamble, to generate or increase the amount of deduction for the interest expense. In that case, the interest is not deductible. Further, according to the proposed regulations, if the loan obligation carried an extended loan term with a single balloon payment that does not correspond with the estate's ability to satisfy the loan, the preamble states that the interest accruing on the loan is not necessarily incurred in the administration of the estate, and therefore is not deductible. Now, here's the nub of it. The IRS appears to be extending scrutiny not only to actions taken after death that may create illiquidity, but also to estate planning during the decedent's lifetime, which produces illiquidity post-death as a byproduct. This is seriously problematic because it overlooks that there may be significant non-tax reasons for taxpayers to structure their holdings in ways that may not be liquid, including, among other things, to ensure that subsequent generations don't sell inherited business interests that the decedent has spent a lifetime building, sometimes from scratch. Further, what about ILITs, Irrevocable Life Insurance Trust? One of our favorite devices to produce liquidity post-death in an otherwise illiquid estate. And an ILIT is commonly employed, of course, as a source of liquidity outside of the decedent's taxable estate. And how does it work? You have the trustee of the islet often lending funds obtained through the life insurance proceeds to the executor to help fund the payment of estate taxes. Question: in that situation, is the interest on that loan deductible, or are there limitations on it? Again, an area that under the proposed regulations left a major question mark. Next point, fourth point of the proposed regulations, there are changes in requirements establishing the value of a claim against an estate. According to the preamble, the IRS considered the application of the so-called qualified appraiser and qualified appraisal requirement in this context. Proposed regulations instead require a written appraisal signed under penalties of perjury that reflects the current value of the claim when the Form 706 estate tax return is being completed. The last point in the proposed regulations, before we delve into ACTEC specific comments, deductibility of amounts paid under a personal guarantee. What the proposed regulations do is they set the baseline, or repeat the baseline, that a claim founded upon the decedent's personal guarantee of another's death is a claim founded on a promise and accordingly must satisfy applicable requirements. Specifically, the guarantee must have been bona fide and in exchange for adequate and full consideration or money's worth, as opposed to gratuitous, even if enforceable under applicable state law. In addition, those regulations provide that the estate's right of contribution or reimbursement will reduce the amount deductible. Now, the proposed regulations go on, though. They provide what seems to be a bright line rule, that a decedent's agreement to guarantee a bona fide debt of an entity in which the decedent had control within the meaning of Section 2701B2 of the Internal Revenue Code. At the time the guarantee satisfies the requirement that the agreement be in exchange for full and adequate consideration in money or money's worth. Alternatively, proposed regulations then say that this requirement also is satisfied if at the time the guarantee is given, the maximum liability of the decedent under the guarantee did not exceed the fair market value of the decedent's interest in the entity. So you have those two items listed. What about everything else? Silence. Silence. And the concern with silence is it could be construed to create a negative inference, right? That the decedent's personal guarantee in circumstances that fall outside these circumstances may not give rise to an estate tax deduction, even though the decedent may have had a substantial interest in the entity. So ACTEC's comments address the last three of the topics that I just mentioned. First off, and I'm going to do very high level, there's a lot more nuance, invite everyone to review ACTEC's comment letter on this. Regarding interest expense on certain loan obligations, as noted, the proposed regulations express concern about perceived attempts by estates to produce illiquidity that can cause estates to enter into loan agreements with related parties to generate interest deductions under Section 2053. Although, as ACTEC acknowledged, Treasury's concern is understandable. Prescription that proposed regulations go beyond what is necessary to address this concern, and if adopted in its present form, would also penalize estate and other planning that's significantly motivated by non-tax considerations. So, as far as ACTEC's approach, ACTEC suggests an approach to balance these considerations that focuses in general on the presence of significant non-tax purpose for entering into the loan, with certain absolute carve-outs from any limitations of deductibility of interest. In a nutshell, if there's planning during lifetime that produces illiquidity, that's okay. That should not be problematic in ACTEC's view, even if done within 3 years of death, as long as there's a significant non-tax reason for the planning. What if it's more than 3 years before the decedent's death? That should be per se okay, because it's so far removed from date of death. Also, when he talks about funding arrangements for life insurance, irrevocable life insurance trust, or other arrangements that could be structured with business entities with the same effect, that too should be completely exonerated and should not pose any risk or limitations on deductibility. Second nub of ACTEC's comment letter, written appraisal document. So, as mentioned, in that context, ACTEC recommends that there should be no requirement that a written appraisal document be signed under penalties of perjury. Why? Penalties of perjury requirement doesn't appear anywhere in the Internal Revenue Code. ACTEC further believes that the word, quote unquote, appraisal itself is unnecessarily restrictive and recommends that it should not be used except perhaps as an example among several options. Then lastly, regarding amounts paid pursuant to the decedent's personal guarantee, this comment letter points out that under case law, tax court cases and the like, the guarantor's right to subrogation is considered to constitute adequate and full consideration if the guarantor had a bona fide expectation that the loan would be paid by the borrower, or that the guarantor would be reimbursed if the guarantor were required to make the payment on the loan guarantee. In the view of ACTEC, the regulations should reflect this case law, and that any examples in the regulations should be expressly non-exclusive safe harbors. So that, Doug, is my summary of ACTEC's comments on the proposed Section 2053 regulations with some background on what those regulations provide.
Thank you, Kevin, for sharing your knowledge with us today.
Thank you for listening to this episode of ACTEC Trust and Estate Talk, the podcast series about wealth planning matters from the American College of Trust and Estate Counsel. To find an ACTEC lawyer near you, visit actec.org. Please subscribe to this series and leave us a rating or a review. Follow us on Facebook and Twitter at ACTEC Talk.